Over the past few months, I've been buying large amounts of ExxonMobil stock as it's fallen to its lowest price of the last 15 years. This dramatic fall in stock price has caused the dividend yield to balloon over 10% and led many to question whether the company will cut their dividend. In fact, I've received many tweets and comments asking what I think about the company's dividend safety. In this video, I'm going to do an in-depth analysis of whether I think they will cut their dividend, using statements from Exxon itself and research from many analysts. My name is Zach, and you should leave a like and subscribe to the channel if you enjoy the video. ExxonMobil is a dividend aristocrat, meaning they have increased their dividend for over 25 plus years. The company has repeatedly stated that returning capital to its shareholders through their dividend is of highest priority. However, the safety of that dividend has recently come into question, as the year 2020, to put mildly, has been horrible for much of the economy and especially the oil industry. In 2020, the price of oil tanked, even going negative for a brief period of time due to a plethora of factors. Demand plummeted as much of the world entered an economic shutdown, causing a massive oversupply of oil, thus driving the price down. On top of this, Russia and Saudi Arabia entered an oil price war as both countries refused to lower oil production, exacerbating oversupply and lowering prices even more. This price war actually has a fairly interesting history, and I'll provide a link in the description with additional details if you want to read more about it. All these problems combined with the virus-induced market fear compounded to create a massive stock market sell-off and extreme negative sentiment over the oil industry. The ExxonMobil stock price fell from $60 to $70 to a low of $31.45 in just a few short months. This takes us to March, when investor fear was at an all-time high. The CEO of ExxonMobil, Darren Woods, had an interview on CNBC to address all the concerns around the company.
For us as a company, as we've talked about before, we've got to take a very long-term view. And the investment cycles that we make are anywhere from 5 to 10 years. And so our strategy in laying out our plans is to make investments that are robust to these down cycles, and so that you can ride through them. We've got a key competitive advantage with the balance sheet. And so we build these advantage investments, they're robust to the down cycles, and then we use our balance sheet to kind of ride through these turbulent times to make sure we can deliver on those projects that then form a platform for our business to grow earnings and cash flow for the long term.
That makes sense, but maybe the oil market's even more important for you. When you're watching oil today, like we are, oil at $47 a barrel, does any of that make you nervous in terms of what it means, even though you're looking at longer term? You got to be looking at some of these things and thinking, wow.
Well, if you put it in perspective, in fact, I did that today with the investors, it's easy to get caught up in the short term, in the moment of the markets, but when you step back and look at a lot of these commodity markets, you've seen these price swings before. So we've been in this territory before. And that's why when we're making the investments, we make sure they're robust to those down cycles. So the investments that we're making in Guyana and the Permian are all robust, even below $40 a barrel.
Below $40?
Below 40. So the intent there is to make sure that you're robust to it, so that when you find yourself in those circumstances, you don't regret any of those investments.
When you stress test it, you said that makes sense for a lot of these investments below $40 a barrel. How low do you go when you're running these?
Well, we look to see, we don't have a cutoff. What we look to see is if you look at the fundamentals of those projects and then test them under different price environments, how do they respond and what do the returns look like? And if we get to a broad enough range, if you go back in time and look in history, oil tends to move over time between $50 and $70 a barrel.
Right.
A reasonable range. It'll drop down for periods, but it doesn't last very long down there.
He mentions the ExxonMobil balance sheet and how it's built to sustain the company and its dividend in times of turbulence. Taking a closer look at the balance sheet, they have $12.5 billion in cash, $361.5 billion in long-term assets, and $174.4 billion in long-term liabilities. This is a 47% debt to asset ratio, which is generally healthy, especially considering the extreme conditions the company is under. Also, if you want to take into account the low interest rates right now, then the company will have no problem absorbing more debt to get through these times. Additionally, Woods mentions the past fluctuations in oil prices and how the company is built to be robust in these down cycles. This is incredibly true, and the price of oil has seen massive drop-offs in the past and always returned to a sustainable level. The real concern here is whether the price of oil stays at low levels for an unsustainable period of time, and how the company would react to that situation. The interviewer, Becky Quick, actually asked about this exact concern in the video.
Well,
what if it did? What if this time's different? And I say that simply because of what we're seeing with coronavirus and what that could mean from an economic impact around the globe, starting with China.
So I think what you'd see happen is a lot of industry would pull back.
Yeah.
And particularly if you don't have advantaged projects that are going to generate returns in those lower price environments. The economy, I think, over the medium to long term is going to continue to grow. So the demand for energy, which is closely linked to economic growth, is going to continue to grow. And so I think what you'd see eventually is that capacity that's online, as it declines with natural attrition, you're going to get a supply and demand gap between what's available and what the world needs from an energy standpoint, and then prices will come back up again.
I mean, the oil prices are down today. Last I checked, 1%, even after OPEC said that it's going to make this big cut to production. Why do you think that is?
People are taking a position on what the economic growth is going to be, I presume, and then what the demand will be associated with that. Frankly, again, I come back to we're not in the business of trying to figure out where prices will go, but instead make sure that the investments we make are robust to those price sets. It comes back to the fundamentals. We keep looking at what's going to drive the demand for oil and gas, what's going to drive the demand for energy, and it's going to be economic growth and people moving up into the middle class with their prosperity growing. And our view is that's going to continue. It may get slowed down for different reasons. Maybe the coronavirus slows some things down for a while, but you're not going to stop for the medium to long term. People aspiring to a higher standard of living and economies continuing to grow.
That makes sense, again, from the projects and the profitability perspective of that. But there have been some numbers run just in terms of paying the dividend. You guys have a very high yield, 5.7%.
Right.
JP Morgan ran something that said they think oil prices would need to be at around $81 a barrel for you to be able to pay out the whole dividend versus, I think, $63 is what they put for the rest of the U.S. group. How do you look at just in terms of shorter term paying the dividend over that period of time?
So I think, we have a balance sheet that allows us to do this. We have a capital allocation priorities, making sure that we invest for the long term so that we have the sustainable growth platform, making sure that we pay a reliable and growing dividend, making sure that we maintain a balance sheet that allows us to ride through those cycles. And then if we've got things, extra cash going into buybacks. And so that balance sheet that we've historically had is built for times like this to ride through it. Frankly, the way we look at it is we're generating enough money to pay our dividends. What we're using a balance sheet for is to make these strategic investments that are advantaged versus the rest of industry and will be required as economies continue to grow and demand picks up.
But to pay the dividend, if oil prices stay low, let's say the economy suffers for a while longer, would you cut back on some of those projects that you've been investing in? Would you buy back fewer shares? How would you do that?
So what we talked to the analysts today about is we've got flexibility. We've got a really robust portfolio of investments, and they have different time cycles associated with them. So some of them we can pull back and defer some of that spending without losing the advantage of the project and without diminishing its value. And so we've already started to do that, to pull back on some investments, recognizing the environment that we're in without changing the structural improvements that we talked to the analysts about 2 years ago. And today what we told them is we've been delivering on those structural improvements. We're on track to double earnings and cash flow by 2025 compared to when we first rolled this out in 2017. So we're on track with all that, and even with the deferrals that we have put in place, we're still on track to that. We have put together over the last several years an investment portfolio that's the best the company's had since Exxon merged with Mobil. And so it's a really rich opportunity set. And it's an organic investment profile, the program that has very high returns. It's robust to these low price environments. So we've been advancing that. We've got balance sheet capacity. If a unique opportunity was to present itself, we could take advantage of that. But it would have to be pretty attractive to compete with the organic things that we already got in the portfolio. Speaking
of ExxonMobil and the merger of the two, we've also seen the biggest pullback in the shares since the merger of Exxon and Mobil together. Does that get frustrating for you?
Well, I think, the market, it's hard to draw conclusions from the last several weeks. And I think more generally, the energy market or industry has been out of favor with investors. But again, I think it kind of comes back to the cyclicality that we see in this market. Energy is going to continue to be needed for a long time to come. Oil and gas will be needed as a form of energy for a long time to come. So I think we got to be a little bit patient, let the market kind of move through its highs and its lows.
It's interesting how much of this hypothetical scenario has played out as true. The price of oil has been at $40 for many months now, and there hasn't been any indication of a price increase. In result, ExxonMobil has decreased much of its investments and even cut back on cost in a major way. They had layoffs in their company trying to streamline their operations and even temporarily suspended their employee 401k matching benefit. In April, CEO Darren Woods had another interview with CNBC where he spoke in greater detail about the company's dividend commitment.
Hey, Darren, your dividend yield as of yesterday's closing price was 8.6%. That's an incredibly high dividend. How do you plan to protect that? How do you continue to be able to say that you feel like that is safe?
Well, we have, over the decades, put a lot of priority on maintaining a strong balance sheet. We recognize, this industry has its ups and downs. It's a capital-intensive commodity business, so we know we're going to go through cycles, and the way that we have prepared ourselves to manage through those cycles is to maintain a strong balance sheet, and that continues to be the case today. Of course, over the longer term, to maintain that balance sheet, you've got to have projects and invest in advantage projects. So that is a key priority. And of course, a lot of our shareholders are retail shareholders, people who depend on that dividend. So we've been pretty committed to maintaining that and if necessary in the short term, using the balance sheet to support it. But primarily that balance sheet is to support the investments in these industry advantage projects. That is the focus to maintain a very strong foundation for the future.
Just talking about the balance sheet, you were downgraded by S&P to AA stable from AA plus stable. So what do you think about that? How does that impact you, or does it?
Well, the philosophy that we use to manage the balance sheet in our finances has not changed. It's always been there as a tool to leverage in the down cycle, and we're doing that today. If you look at where we're at, our leverage today compared to the broader industry and our peers, still very competitively positioned. And we expect as we go forward, we'll draw on that and use it. And when the upcycle comes, which it will, we know that, the energy is going to continue to grow as populations around the world grow. Certainly been impacted in the short term by the COVID-19, but a recovery is on its way. It's just difficult to tell when it's going to arrive. And so when that comes back, we'll rebuild that capacity. But we've got plenty of capacity. And frankly, that has always underpinned our strategy to make sure that in tough times, we have that available to us. I would say we're building a plan that doesn't depend on a particular recovery curve. The idea is to make sure that we get our spending down, we get as efficient as we can so that we can ride through this and expect then, again, some of these fundamental factors that drive the use of our products, growing economies, people's standards of living improving, those are going to continue to be there and will eventually kick back in, and we need to be ready to meet those demands when that recovery happens.
So far, this commitment to the dividend has shown to be true, and on July 31st in their Q2 earnings call, they announced that they'd sustain their dividend and it was paid out to shareholders on September 10th. It's important to note that prior to this announcement, I saw a countless number of articles claiming that Exxon was going to cut their dividend, and overall market sentiment was extremely negative around the stock. Now I see the same articles on a near daily basis about an Exxon dividend cut coming soon, but it remains difficult for me to see why the company would change their plan now. If they were going to cut their dividend, I feel that they already would have done so. Also, Woods has reiterated many times that they have no idea when the oil market will return to healthy levels and that they're prepared to push through these downswings. Through every downturn, they've not only kept but continued to raise their dividend. It would not surprise me at all if by the end of the year, ExxonMobil raises their dividend, likely by just a small amount to be symbolic. In my mind, this symbolic dividend raise is actually more likely than a dividend cut. Now I know what many of you are probably saying. Zach, the dividend yield is currently over 10%. That's way too high. They surely must cut their dividend. Frankly, I don't find that logic to be sound. The dividend yield is just the annual dividend payout divided by the current stock price. That doesn't necessarily reflect the company's internal operations or ability to pay the dividend at all. ExxonMobil has not raised their dividend since last year, and at that time it was a 4.23% yield, which is pretty normal. All that's happened is their stock price has decreased dramatically dramatically due to many of the reasons discussed above. Additionally, they were recently removed from the Dow Jones Industrial Average, only adding to people's negative outlook on the company. However, I think the negative sentiment around oil companies is so strong, the stock price has fallen far below its true value and is not reflective of its medium to long-term outlook. I think a large amount of this is being driven by a get-rich-quick culture in investing, and there seems to be no direct indication when the oil market will begin to recover. Last month, I listened to an interview with oil analyst Paul Sankey, and I found it offered a very interesting perspective on ExxonMobil and oil companies in general.
Well, look, your whole debate about decades of under and outperformance is spot on. When I started in 1990, you couldn't give away an oil stock. The 2000s, as you know, was a huge for oils, and we've had an absolute disaster in the past decade. And I firmly believe that the next decade is going to be great for these stocks. The thrown out of the Dow is sort of irrelevant in its own way, but of course it is, as you say, an ignominious moment in history and a humbling one. But Exxon's yield is now not. You haven't mentioned. You guys are all spot on, but you haven't mentioned this nearly 9% yield. And really a model that we're now looking at as a tobacco stock type option, where ultimately as the companies really focus on dividend and increasing free cash flow and really don't try and grow, this is going to be a very different investment case over the coming decade. And furthermore, now that we're not chasing growth, you're going to see oil prices, I think, rally back very, very strongly over the next 5 years.
Hey, Paul, it's Tim. Thanks for joining us. So you're talking about the dividend first. I mean, is it safe? Is it absolutely ironclad? And then relative value of the super majors, of the big integrateds. Why is Exxon performing so much more poorly than Chevron or Conoco?
Well, to start with that one, they've made some bad strategic mistakes, in my opinion, over the past 10 years. We'll go back to the XTO deal, the entrance to Iraq, and more recently, the pursuit of growth in the Permian, I thought was a huge mistake. But the yield now has been absolutely reaffirmed by the management on the Q2, the most recent call. They absolutely stated they're going to keep paying the dividend. And if you think about the financial firepower of Exxon, I think they absolutely will pay this. By the way, Chevron just borrowed money at its lowest ever coupon. So don't underestimate the financial firepower of these companies to pay you. Of course, you've seen a dramatic change of strategy, a huge change of strategy from BP, going after the environmentally friendly theme, but ultimately having to cut their dividend in half to do that. More importantly, BP said they would cut their volumes by 40%, which again underlines that you're going to get a really tightening supply side here as demand post-COVID recovers. And by the way, COVID showed you how dependent we are on oil. That's absolutely incontrovertible. I mean, the fact is what you've seen is how the world economy still runs on oil. And the whole environmental theme is really a problem for utilities. The transport side of oil is still very strong and will remain so. There really is almost no penetration of electric vehicles, and it's impossible to penetrate into jet fuel and ships. So ultimately, I think this is a cyclical low for these names as well as a secular low. I see the cyclical and the secular both shifting positively here.
Is oil going to be as important a commodity in a decade from now? Will we talk about it the same way you're talking about it now?
It's going to depend on electric cars. I think that you can obviously see the share price performance of Tesla and the market buying into the idea of electric cars. But in the medium term, the next 5 years, what we're doing is we're resuburbanizing in the US, and that's going to be driven by gasoline. And as I mentioned, really for jet fuel and ships, there is no electric option. So it's all about transport. Additionally, if you look in China and India, you still have a huge amount of consumption of oil, for example, through propane and other fuels that will just keep growing. So, the market obviously is buying the fact that we're going to shift the energy system here. And I've been saying for 15 years that the 21st century will be driven by electricity. But the reality is you've gone too far and you're underestimating or overestimating the ability of the global economy to shift towards alternate fuels. And you can see that really visibly in California. And by the way, that's entirely an electricity problem, which again is a problem for utilities. So although the theme is being bought so hard, the reality is going to be that these companies will be paying out big dividends and I think even buybacks over the course of the next 5 years. And that will be very attractive to shareholders.
last quick question, Paul, as you had said that people will cycle out of growth and go into names like ExxonMobil. This almost sounds like a sort of prediction, maybe a pairs trade of shorting some sort of growth stock, maybe like an Apple, which is just diametrically opposed to Exxon at this moment in the markets, and going long Exxon.
Yeah, I'd add one more thing. Look, we're going to get inflation. And if you get inflation, growth stocks are going to be a problem. And the way you're going to manifest inflation, in my view, is by rapidly rising oil prices. So there's not going to be inflation until we tighten the oil market. When we do, oil's going to go back to the moon. And you mentioned how quickly Exxon deteriorated. Don't forget that at the end of last year, we were at $60 a barrel, and it seems, a lifetime ago. As for shorting Apple and buying Exxon here, I'll do it. I'll come back in 5 years and we'll see how they do. Back at the beginning of the 2000s, when I first came to the US, I used to bet salesmen, you name any stock and I'll bet you against my stock. And they would come up with some terrible small cap name. I would come up with Exxon. I never lost that bet. I haven't made it for 10 years. I'm making it today. I'll go for it.
I found this interview to be very interesting, and to be honest, I agree with much of his views. His statement that oil companies are becoming more like tobacco stocks I think is a very accurate comparison. Also, I think their focus on the dividend and generating cash flows will prove to be very true for years and likely decades to come. This is backed up in the Trefis fundamental analysis, which predicts free cash flow to increase from $12.23 billion in 2020 to $21.59 billion in 2026. On top of this, I think that investing in ExxonMobil right now has potential for major capital appreciation when the oil market recovers. As recently as September 28th, Bank of America Global Research has ExxonMobil and Chevron both rated as buys, with ExxonMobil having a price objective of $77 and Chevron of $96. They reiterate the strong balance sheet and that they expect both companies to keep their dividend. These companies are no longer growth stocks, and they haven't been for a while, but right now is a fantastic entry point in terms of yield on cost and capital appreciation as the oil industry recovers. If you believe that they will hold the dividend, then from a dividend investor perspective, why would you not invest in ExxonMobil right now? I see it as a massive source of cash flow generation in the long term and a source of significant capital appreciation over the next few years. I think this is a classic example of buying when there's blood in the streets. Of course, not everyone agrees with this perspective. Many people will invest over climate concerns and worry over oil's long-term future, but I remain convinced that the negative sentiment is massively overstated on these companies. I think it's most likely that ExxonMobil sustains and continues to raise their dividend in the long term. This is just my prediction, but we will all find out in October as ExxonMobil has a planned Q3 earnings call on October 30th. ExxonMobil is one of my holdings in my long-term dividend stock portfolio. Currently, I have 88.84 shares of XOM with a compounded dividend yield on cost of 7.81% and a cost per share of $45.50. So in total, I have $3,958.61 invested in the company. My plan is continue buying while the price is low, and I'd like to drive my price per share below $40 if possible. However, don't take my advice blindly, and be sure to do your own research before making any investment decisions. Thank you for watching Dividend Data. I'd greatly appreciate it if you could leave a like and subscribe to the channel. If you follow me on Twitter, link in the description, you can get real-time updates of my buys and dividends coming in. You can support the channel on Patreon and be a part of making these videos happen. The link is in the description. Please leave a comment below, and thank you for watching.